Let's say you have 100 rupee to invest. You're okay with losing 5 rupee. Take that 5 rupee, you do whatever you want with it. Satisfy all your behavioral biases using that. you virtually gamble with it, it's okay.
What are the big forces that you think are shaping the investment outcome?
Global geopolitical situation is very fluid right now. Tail investors are the ones who end up losing money a lot.
Welcome to another episode of Tech Wealth Chronicles, a podcast by CrispIdea, where data meets the decisions and numbers reveal the narratives. I'm your host, Malay Shah. Having spent more than 25 years of my career in management consulting and transaction advisory from my early days at EY and McKinsey to right now being a co-founder at CrispIdea, we understand the importance of the right financial architecture for individual and companies in shaping the trajectories of the companies or the individual's personal wealth management. This podcast was born out of a very simple conviction that today's tech leaders and entrepreneurs really need a research-first, tech-first approach to build their wealth. And today I'm joined by a fellow practitioner of that same approach who follows tech-first and research-first approach to wealth creation. He's the architect of passive investing revolution in India that has already scaled past more than $1 billion in asset under management within a record period of time. Today, we are going to deep dive into the mechanics of that disruption with the CEO of Navi AMC, Aditya Mulki. Aditya, you have fundamentally challenged, the high cost and a low tech legacy models of Indian asset management. And I'm really looking forward to get into under the hood of that particular disruption so that our audience can learn more from that entire approach. Welcome to the show, Aditya.
Yeah, thank you so much for having me, Malay, and it's a pleasure to be on your podcast.
Awesome. Now, before we get into the details of the podcast, I just wanted to send out a general disclaimer that this podcast is meant for educational purposes only. Anything that Aditya or I say doesn't constitute a financial advice. And it is possible that employees of CrispIdea or employees of Navi may actually be holding positions in any product mentioned in the course of this podcast. So do not rely upon anything said in this podcast as financial advice, and please consult your financial advisor for making any investment decision. So let's get right into the thick of things, Aditya. Personally speaking, I'm very, very excited about this particular podcast. Your entire career evolution has been quite exemplary. We have got a very soft spot to someone, who comes from equity research background, we ourselves being that kind of firm. But let's deep dive into your journey first. And why don't you tell the audience about your journey, right? I mean, what drew you into this particular field? What has kept you going over the years? Maybe you can start off with that.
Yeah, so I'll answer the first part first in terms of what drew me into the field. So, when I was in college, so 2009-ish, somewhere 2009-ish, there was something called the Eurozone crisis, which was going on at that point in time. So I used to read a lot about it. I was obviously, I was doing I was a BCom student. So at that point, you really don't know what you're doing. So you try a bunch of stuff. You try doing CA. You try a bunch of stuff. So I was in the midst of that. I was, appearing for my CA intermediate exams at that point in time, and to be honest, even though I had reached the intermediate stage, if you asked me at that point of time, what does the stock market mean? What does it mean when it says Sensex is up by 1% today? I would not be able to answer that. I had no clue. And that sort of bothered me a little. So I approached my senior and I was like, please explain to me, what does this exactly mean? The markets are up 1%, down 1%. What does it exactly mean? And I went there, then he explained that to me. And even then it wasn't clear the first time. Then I had to, at that time, I think people take it for granted. Today, if you want anything, you just look it up on your cell phone. Today, there's even an AI out there who's giving you. It wasn't that easy. You were still probably on 3G networks.
Right.
And so, but I tried Googling it, how these indices are created. So I went into the mechanics of it and I thought it was very interesting. And coming back to my point of, then I went back, what was happening in markets. I used to read a lot of Bloomberg, whatever articles you used to get some free articles in Bloomberg. After which you had to pay. So I used to just read some of those articles, and then Eurozone, they used to talk about that a lot. And then I went into depth in terms of what happened in Greece, the debt crisis there. And then eventually they even went over that and and you were actually getting Greek bonds at steal away prices.
Right.
You were getting it at very high yields. Investors would have made a lot of money. So that is why my journey initially started. And then what happened was, I was once in a very interesting story. I was once in a library. I was just randomly looking for books on investing because I had already, as I said, there was some interest in the field. So there's a book by Roger Lowenstein on Warren Buffett. I found that book, and the library had some sort of a sale or something going on, wherein they were offering books at so I got that book for like 7 or 10 rupees or something. Like it was just steep. Firstly, I read some 100 pages in the library, and then I figured out they are okay if I can even buy it, and I can buy it for like 7 or 10 rupees. So I just took it home, and that's when I you could say my interest in the research sort of sort of took up. So
and this was all happening in Mumbai, right? I mean, which is where you grew up.
This is all happening in Mumbai. I was born and raised in Mumbai. I've done my schooling, my college, everything in Mumbai.
Right.
So then I did that, and then obviously at that point in time in 2000, would be 2012 or something. I was thinking, what is a curriculum that I could study that will help me understand this better, and I can make a career around it. So there were a couple of options open. I could have either done an MBA or CFA at that time. There was still an issue wherein sometimes to appear for the exams, you had to go outside India. The centers weren't in India because of some reason.
Okay.
But I think in that year, it became very clear that they were going to hold exams in India. So I registered for the CFA curriculum, and post that, obviously, the journey started. And then I got my first break when I was looking for a job in 2015 at Quantum Advisors. So they are also very, very heavily research driven.
Absolutely.
A very heavily research driven org. And, in my formative years, it was very helpful that I joined that institute, and it helped me really. So I mastered the details there like I wouldn't have if I was at any other place. That's what they do. Every company, like every stock that we researched, we needed to know absolutely everything.
Everything about it.
Absolutely everything.
Your thesis had to be clear, had to be bulletproof.
Yes.
All of that, right?
From where the manufacturing is done, to who are the distributors, how is the entire supply chain, who are the customers, who are the peers, how do these businesses do in the West or in China or in some other countries. So it was that comprehensive.
And just help me clarify, like, isn't quantum focus was like more value driven investing? I mean, and I think that's where you kind of also aligned to that approach.
Yes, I was also aligned to that approach because typically it will happen with a lot of fund managers and analysts here. You'll start reading stuff, Charlie Munger, you'll start reading Warren Buffett, and that's the path that most investors take. But I also was fortunate enough to also read Philip Fisher very early on. So I read his book, which is on growth investing, and that was written. He's talking about growth investing in the 50s and 60s in the US. So late 50s, early 60s in the US. So that gave me another perspective. So although inherently my style would be much more value, but I also understood the other side, which helps in a market like India.
Right. Absolutely. Yeah. India is completely growth driven market. But then you shifted from equity research to a fund house. Now tell us maybe a little bit more about how your investing style or approach has changed, right? I mean, through those formative years, you mentioned, you were aligned to value driven investing, you learned about growth investing, but like over the years, how did your personal style of investing really change?
One thing that I always liked doing was I was always seeking out people who did not agree with, let's say, a deep value style of investing or something. What are their point of views and why? If you get into the why, you'll get a lot of answers in terms of why they're saying what they're saying. So as you said, in a growing market like India, which is growing at a rapidly fast clip, and it might continue to do so for, let's say, another 5 or 10 years as well. That might happen. So wherein it's very difficult for you to get businesses at deep discount to their intrinsic values. Because the businesses are growing at a fast clip, and the nature of those businesses are changing, fundamentally changing. Today, you have a Zomato in a Nifty 50 sort of an index. That's only one company which is new age, which has no physical assets or something. So in the long run, that's a high ROE generating business which will command a higher PE. So once, let's say, 10 or 20 more of those stocks come into the Nifty 50 tomorrow.
It will change the entire composition.
It will change the composition. It will change your metrics. Your PE is very regime sensitive. So
Yeah.
those point of views. So then I even understood the other side.
Mm.
And then, you can always draw parallels. Charlie Munger says this very beautifully. If you want to be a great fund manager, you don't only read about stocks. You read about absolutely everything. You read about biology. You read about physics.
I think that's the fun part of being in this
Yes.
industry, right? That you can
Yes.
be if you have a generalist approach to everything,
Yes.
and have that curiosity, I think your style of or your outcomes on investing will become far better.
Absolutely.
Yeah.
And one thing that happens with that is also you can apply frameworks from other disciplines. Like engineering has a lot of frameworks. Like engineering frameworks are very precise. For example, how people are trained in the armed forces. Now that's very precise, very precise. If now today, since I'm also the CEO, even I do a bit of strategy and all of that. But once you read that, you understand that the military is far more evolved because the consequences are far more severe than us.
Right.
So you can apply those models to your real life investing. And one thing was very clear, just to wrap it up, was I understood very early on that there is something in the markets which is not predictable, right? I can tell you what I think the Nifty 50 will do.
Right.
But there is always a behavioral element there in terms of how investor sentiment moves, which is very difficult to predict.
Right.
And very difficult to put a number on also.
Right.
So if you're cognizant of that, so that was a big change in terms of I became much more cognizant of that in my approach, and not just only numbers driven. There is something that I know I cannot predict.
Right.
And I have to be okay with that.
Yeah, that brings in an element of humility in all of us, right?
Yes.
That we are in a field about forecasting or about telling what's likely to happen. At the same time, while knowing that, we may never know, what kind of black swan event will happen or how, people will react to it. So
absolutely. Yeah.
Wonderful. So I think looking back on your journey, right, is there one decision or moment, kind of that shaped how you think about investing today, right? And like, especially what did teach about, teach you about yourself as well?
Yeah. So one moment is, when I became a fund manager. So that happened in Navi and sometime in 2022. It's very easy when you're an analyst to say you buy the stock, you sell the stock. There's no ownership as such.
Right.
It's not really.
You're not putting your money at risk, right?
Yeah. More than money, it's not your head that's going to fall if something goes wrong. Right. It's the fund manager. You will have there might be some filter on effects, but more than that, it was once I became fund manager, I was like, I'm managing people's money.
Right.
So every decision that I took, I overthought everything. I wanted to be doubly sure, 200% sure that I'm not investing. So I was very tentative in my early days, very tentative to buy a new stock, to sell something in the portfolio. I was initially very tentative. And then I quickly realized that in a very competitive environment that you are in the mutual fund industry, the one thing I observed was, and that also changed my investing style, is because you prioritize being very safe or not taking calls even with calculated risk, what tends to happen is your portfolio will start looking very benchmark like. And an investor should not be paying a high fee for that. So I realized very early on that the first change that happened was I always prided myself on I'll have an active share. Our active schemes will have a very high active share. It should be nothing like the benchmark because we have a superb suite of passive products that can give that to you at 1/4 the cost, basically.
Right.
At 1/4 or even some cases 1/10 the cost.
Right.
So that was one change that happened, and another change that happened was I also started appreciating a lot of broader level factors. So what could happen is I know this business X looks good. But I know for investors to realize that this will look good, only then will I actually realize returns. It's not going to happen in a year's time. So maybe I can even wait it out. So that changed in terms of, initially I was always like, this is a good business, just invest, sit on it. But investors do not have patience, and that patience seems to be waning with time.
Right.
So that was one change that.
And I think it's a huge change because as you rightly mentioned, when you are managing people's money, you are managing their dreams, their aspirations, etc. as well. So there is that element of higher accountability that comes along with it. And then on the other hand, you will never have perfect information, right? I mean, as an analyst, of course, you will research a lot, But as a fund manager, you may still want something more, but you may have to take decision with 80%
Yes.
of the information out there
Yes.
as well, right?
Absolutely.
And then the third part is timing, because
Yeah.
so there are a lot of other factors which come to work in terms of ensuring something works, but within a stipulated period of time, right? So as well. So I think all those are brilliant points.
Yeah.
So let's shift into the next topic, and we are living in very interesting time. I mean, we saw 2025, going through peaks and troughs in the global market. India, of course, underperformed. 26 again seems to be, we just saw what happened with Supreme Court in the US on Friday, and the market reaction in all the global markets today. So we are living in, by the way, very interesting time.
Yeah.
And I think we want to talk about this section in terms of your view on both on global and India market, right? So when you look at the global markets today first, right? I mean, what are the big forces that you think are shaping the investment outcomes, or that will shape the investment outcomes, let's say over the next few years? Because I think we saw from 2020 till 2024, a kind of boom era, which was a little more linear.
Yeah.
But from here on, over the next few years, I mean, what are the kind of investment outcomes that one should anticipate? Your view?
Yeah. So that's a very interesting question, actually. So one of the things that's very interesting here is that we are living in times. One of the biggest changes that is happening is the global geopolitical situation is very fluid right now. So if an investor is trying to predict that and invest based on that, it's going to be very futile. History has shown us that trying to predict macro level events is one of the hardest things to do.
Right.
So don't spend time on it. There's it's in my view, at least, it will be fruitless.
Right.
You can have a very you may have all the data in the world, but trying to predict these events is going to be very difficult. A lot of economies have now, you can use this word, I don't know if this is even a word, deglobalization.
Right.
Markets were very open in terms of economies have become very inward looking right now. From especially the Western economies, especially the US.
Right.
So there is a lot of sentiment in terms of negative sentiment in terms of even migration.
Right.
And then in terms of even importing products, why can't we manufacture that ourselves? So a lot of that theme is picking up. So that is one change that investors need to watch out for.
Right.
That will have implications.
Right.
Another broader level themes which investors will obviously be aware of, and they're highly talked about, are obviously the advent of AI. AI is coming through, but to be honest, nobody knows what's going to happen over the next 2 or 3 years in terms of how this technology will evolve, what would be the exact use cases,
right?
What sort of new jobs will it generate? So what type of old jobs will it take away? Now, we are not sure about that, but that's a change that you need to be cognizant of. And another change is clean energy. I think we don't talk about it much in India. And I think some people, although even I do agree, based on the facts we have today, it's very difficult for us to say that oil or something will go away, even over the next decade or so. It looks very difficult. But with these things, what can happen is there could be a major leap in technology. If something like that happens that none of us can predict, that transition could be faster toward clean energy. That is one. Those are changes that investors should be mindful of.
Right.
Yes.
So I think what you are saying is clearly geopolitics, of course, is a sensitive environment, but in past, Russia-Ukraine has happened, or even Kargil war has happened. So, but investors should not pay too much attention to this. They should be aware that that's an important piece that will play out, but not get overly caught up with that. Second, what you are saying is, yes, AI is a theme that we are living through, but we don't know, what the ultimate outcomes are going to look like. And the third, that what you are talking about, is the entire potential clean energy transition, right? I mean, those are some of the mega themes that one has to watch out, when they are thinking about global investing. So coming back to India, right? I mean, India has been in a very interesting situation. We have gone through almost a year of underperformance relative to the global markets. Of course, people have always complained that India has been an expensive market. Some people still continue to think so in the global landscape. But where do you see India, at this particular moment, right? I mean, where does it stand from the opportunity perspective or from a valuation standpoint? And can our underperformance, can it really reverse, and can we really outperform, let's say, in 2026? I mean, what's your view from Indian equity perspective?
Yeah. So the consensus earnings estimate also for your FY27 or something would be, I think people are saying around 13 to 15% earnings earnings growth, right?
Right.
The Nifty 50 gave you a return of around 10-11% last calendar year.
Right.
So assuming that prices do track earnings growth, uh, I mean, which is not there's no clear linear relationship in the short run.
Right.
When might be in the long run, but you can expect a year which is, in our view, slightly better than last year. But having said that, the markets are fairly valued. They are not undervalued. 20 times forward PE for the Nifty
50,
it's fairly valued. But so we have to be mindful. And what has also happened is something interesting I would like to point out is last year when we were going through a bad phase, when the markets were going through a bad phase, a lot of money moved into large caps or your Nifty 50s.
Right.
And then there were funds that gave you the top 10 in Nifty 50 and all of that. Because even the Nifty 50 was driven by the top 5 or 10 constituents.
Right.
Because those stocks hadn't done well for a long period of time.
True.
And suddenly they came to the fore and and because they obviously offer higher safety and all of that, lower volatility. And now those have started doing well. Now something similar which has happened in the US is there was a boom even in the Nifty 50 in the US. It's happened historically in terms of people said that the Pareto will hold true in the long run. So the larger companies will be 80% of the market eventually. So you can just invest and forget about it. And then valuations moved to into zones that were unseen before. And then there was obviously a correction. So right now we are not there. We are nowhere close to that. Right. It looks, India looks fairly valued, but this is not a time wherein an investor should be very bold with his bets in terms of, for example, if they want to go overweight large caps, overweight mid caps, overweight gold, a very balanced allocation with a bit of international diversification will help a lot in these current times.
Right. So what you are saying is clearly India has underperformed, but that has actually helped valuation becoming more normalized.
Yes.
And the go forward expectation is that it should definitely be better than last year. But definitely it's very kind of what you are saying is a balanced approach is still better as opposed to betting on just one particular asset class, right? I mean, like for example, gold silver did phenomenally well. So some people have been trying to chase those returns. Absolutely. But instead of kind of doing that, I mean, be mindful of the asset allocation across gold, across international equities, across large, mid, and small cap as well, right? Yes. That's primarily what you're. But do you still find any better spots within that overall framework? Like for example, some people, of course, mid caps, have corrected a bit, but mid caps still seem to be fairly expensive in terms of the forward multiple, etc. But are there better value opportunities, let's say, available in small cap now relative to what they were earlier, what they were available earlier, etc.?
Yes. So this also depends on the time horizon that an investor has. Because let's say investor is only looking 1 year forward. If you're looking 1 year forward, then you shouldn't look at any of these. Just have a balanced allocation. Just sit on it, because it's going to be very difficult to predict what business will do extremely well over the next 1 year or something. But there are clear themes in the Indian market. For example, if you travel to a tier 2 or tier 3 city today in India, the development that has happened in those cities is phenomenal. The sort of infra that is being built in cities like, let's say,
Surat, Indore, Nashik.
Absolutely, Indore especially has come up. If you look at AMFI has a list of, you can get this on AMFI's website, cities by AUM. Like 4th, I think, is Pune. The top 10 has like 2 or 3 cities from UP today.
Wow.
It's Lucknow and Kanpur and all of those. So those cities have come up. So our growth is broad based. Now what that gives is your spending power of people has increased. India is a consumption economy, and the discretionary story that people have been calling out for ages. Like I remember 7 or 10 years back, people saying consumer discretionary is the theme to play, but that was not the right time. Now we've reached an inflection point wherein our per capita incomes are that high. You see the spending power. To be honest, 7 or 8 years ago, if you'd ask me what type of car would you be able to buy, I would say it would be a very simple hatchback. But today, absolutely everyone can afford. And everyone can afford, and most people can afford an iPhone today.
Right.
So that gives you those plays. But again, for those to play out, it's a longer run theme.
Right.
It's a longer run. So that's how we look at it. Very bottom up. If you can identify these themes, there are pockets of growth. And you're right. You talked about small caps a bit. There is a good, healthy correction has happened in some of these stocks.
Right.
Wherein you can get some of these businesses at very, very attractive valuations right now. And in the long run, if you have a long holding period of, let's say, 5-10 years, those bets will pay off.
Right. No, understood. So I think what you are clearly saying is time horizon is going to play a critical role. And but in the short run, there would potentially, still the risks be out there, and one has to still manage their asset allocation in a more disciplined manner, is what you're saying, right? But like, what are the risks which are still out there for Indian investors? Because, like, for example, when we talk to many other, either wealth managers or fund managers, the standard reaction is like, what how bad it can get from here, right? Like, for example, everyone has suffered in last 18 months. Markets haven't gone anywhere much. FIIs have still been selling, so they're basically telling that we have seen every single kind of disruption out there, from Trump related tariffs to FIIs constantly selling in the market, etc. So from that standpoint, they are kind of, at least it appears that they are more kind of bullish that, hey, all the negative is factored in. But like, when you look at, let's say 12 months out, like, what are the risks that at least you want investors to watch out for from an Indian investor perspective?
So one clear risk that we also spoke about, I think, a while back, was geopolitical uncertainty. That's something that's going to be a theme, in my view, which will run for the next couple of years at least. Because let's say we are happy today that Trump revised tariffs, and tomorrow he wakes up and he says, no, I don't want to. There's something has happened, and he doesn't want to do it.
Right.
So what happens to markets then? That's a risk, right? And again, as I said, that risk is very difficult to predict, extremely difficult to predict.
Right.
Let's say we have noisy neighbors as well. We have China, we have Pakistan. Let's say tomorrow something happens on that front.
Right.
So we can't predict that. That is one risk investors should absolutely be aware of and be cognizant of. Another risk is, there are certain asset classes that I think investors are investing right now based on sentiments. For example, commodities as a basket. I'll talk about it. You see small corrections happening now and then.
Right.
But and obviously there are some you could say tailwinds also there, in terms of central buying, gold buying, and all of that. If we only talk about gold,
right?
But people are now wanting to do other commodities also. I know people who've asked me how to get exposure to things like copper, platinum, and all of that. You're going into territory which is unprecedented. So you don't understand what the supply demand dynamics are.
Right.
So be very careful when and always remember, history has shown us this, that whenever investors extrapolate past returns and you think the high is always going to continue, there's always a fall. Anything that goes up is going to go down. There's no way, in life and in stock markets as well.
And price chasing is a bad strategy in general,
very bad
and especially when you kind of extrapolate the kind of boom that we have seen in zinc and copper and silver and other metals, both precious and base metals. I think that's a very, very risky strategy that investors should watch out for. Geopolitics is clearly the other one. Anything else that kind of, like, for example, one thing which I want to specifically get your view on is, FIIs were also selling in Jan. I mean, Feb, I think numbers are slightly positive. We still have a few more days to go in Feb. But like, what will get FIIs back, right? And what are they seeing that maybe, us as retail investors are not seeing, right, in the market?
So from an FII standpoint, if, for instance, I put myself in their shoes, India is a market trading, for example, as we spoke about it, Nifty 50 is trading at 20 times forward P. So it's a fairly valued market. The earnings growth has been reasonable. It's not been outrageously good for us to pay that sort of multiples. Now, from an FII standpoint, there are other opportunities in the market, right? Someone like a Taiwan, who's, if you look at his GDP growth rates, it's been phenomenal. That might be driven
just
by
on the back of semiconductor
or whatever. But you have those opportunities wherein they were trading at, China, for instance, for the longest time was trading at very, very attractive valuations.
Like 10 times.
Absolutely. Which was preposterous in my view. But obviously there are certain other macro factors that led to that. But now they have an option of entering into these markets.
True.
And even other emerging markets like South Africa and all of those. So from an FII standpoint, if something else is looking attractive just on a screen, if I have to pick something else is looking attractive, money will go there. I think we worry too much about what would it take. I think a lot of people also wanted that let the budget come up with something wherein it should be easier for an FII to invest. An FII should invest if it's looking attractive, the markets are looking attractive. If your earnings growth is coming through, those are the right reasons for them to come in.
True.
not because you're incentivizing them and the economy is taking a hit, our deficits are taking a hit and all of that. That's not a great way to incentivize that.
Right.
So in my view, they would come back. But the good thing with India is, and this is now starting to happen a lot, is the DII investors coming in.
Yeah. That gives that solid base.
Yes, and that is starting to absorb. And with mutual fund penetration being only around 5%.
Yeah, compared to 40% plus in developed markets,
absolutely.
right?
So
we still have a huge runway ahead of us. Right?
Absolutely.
Yeah, so the Indian mutual fund industry is having a huge tailwind, in terms of the financialization of investments. And there are multiple players right now. The larger one, like ICICI Prudential, just IPO'd. But would like to know your view from where you are sitting right now, right? I mean, how do you see the industry structure itself? How are players kind of taking advantage of the tailwinds which are available in the market?
Yeah, so obviously, as I said, the penetration of mutual funds is very low, and there was a report called Viksit Bharat 2047, wherein there were projections made in terms of what the industry will look like. I think that entailed 17-18% CAGR growth for the industry, and that's a very big number. If you do the math, it's a very big number for up to 2047. So that's like 22 years, 21 years from now on. So that number's even 17% CAGR for 21 years.
Will mean we'll grow like 40-50 times from here on.
Yeah, so the size itself is staggering.
Right.
Now, from an investor standpoint, this is very good. This is a very good time for investors to come into the fold and start investing in mutual funds. And why I say that is because the growth is so much. What will typically happen in industries like this, you look at listed players, you can look at listed AMCs, you can look at their margins they make, the ROEs they make, and then people understand the entire TAM itself is so large that a lot of new people want to enter. So competition has come in, and with competition, what will happen is it will always benefit the end consumer, who's the investor in this case. So that is happening a lot currently in the industry, wherein a number of new players are entering. We are also relatively new players. We launched our first scheme in 2021. So we've still been around for 4.5 odd years. But there are new players now entering into the fold. And I believe the market is growing at such a fast clip that there's enough room for everyone to grow. As long as you run your business sustainably and don't do something that is, you could say, extremely unsustainable in the long run. As long as you don't do that, that is what is happening. But I would say from an investor standpoint, it's the best time to be
opportunity.
Great opportunity. But with that also comes clutter and confusion, because there are so many fund houses, there's so many schemes right now. So it will become very difficult for a individual investor who's not from this field to understand where to invest his money. You have to spend a lot of time and effort. So even I would suggest there are a bunch of advisors also. You just avail those services. But a good time to be around.
No, precisely. And by the way, Navi has done phenomenally well. Like you just mentioned, like 4 years, you have reached more than $1 billion, in terms of asset under management. And I want to talk about specifically one strategy. And of course, advisors, of course, focus on, like which funds have given great returns, adjusted to risk, etc. But the one other important piece comes is the expense ratio or the cost as well, right? So how do you think about the low cost funds available for long-term wealth creation? How do you kind of reconcile those two objectives, from a fund house strategy perspective?
So for us, obviously, our bread and butter or a sizable portion of our AUM comes from passive funds. So globally, the trend was very clear when you look at global data in terms of the shift eventually does happen. If you look at US, you look at even some countries in Europe as well, the shift toward passive investing happens. But it happens gradually. See, because it's very difficult because the passive will never beat a benchmark, right? It will never beat the benchmark. If it's beating the benchmark, you're doing something wrong, right? Your tracking error will be out of whack.
Exactly.
So you're supposed to track the benchmark. So that's the most you can do.
Right.
So if there are in a market like India, where there are still inefficiencies to be exploited, there will always be some active schemes which will beat the benchmark, right? Which will beat the benchmark. So investors, if they filter basis returns, those are the funds that will come up. So the shift we believe will be gradual,
Mm.
which is why we went ahead with it. When the shift happens,
Mm.
people should understand that their returns compound, so does the cost as well. The cost of investing will also,
Mm.
it keeps hitting you year on year.
Mm.
So, and once the market efficiency starts going away, let's say, might not happen in the near future,
Mm.
might take 5-10 years, let's say, and it becomes difficult to generate alpha,
Mm.
and investor knowledge and awareness grows about passive schemes,
Right.
and that's when the market starts to change. And having said that, it's not even, we are also not in an active versus passive debate. Both products have their
Understood.
own merit.
Of course.
The US market is so big that even if both
Mm.
are 50-50, the
Mm.
absolute size of that is staggering.
Mm.
Is staggering. So even
True.
if
True.
passive tomorrow is 50, active is
Mm.
50, the size at which
Yeah.
the entire industry will be so humongous. There's
Right.
enough room for both.
Right. No, precisely. And I think what you also mentioned for investors is again a very important point, that expenses do matter, because not just from a absolute expense perspective, but the fact that they also compound over a period of time.
Yes.
So it leads into significant wealth erosion as well. I mean, if it's not kind of matched with the right kind of returns.
Yeah.
The another statistics which I heard, and maybe you can correct me if I'm wrong, is that even in India, while it's still active driven market as opposed to US, which is becoming now more passive driven market, 73% of the funds still, I think, underperform the benchmark. I mean, is what I heard is the statistic.
Yeah.
So, but how do you see the growth of passive in India, let's say over a period of time? I mean, compared to where, let's say, US has gotten to right now.
Yeah, and this is just my opinion in terms of if you look at I think passives are close to 17% of the overall mutual fund industry AUM. 17 is passively
17,
managed schemes.
okay.
And the rest would be actively managed. So we have a precedence, right? So this happens in every business in India, not just mutual funds. Every industry you look at in India, we've always looked to the West and we understand what's going to happen there, right?
Mm.
So our move at times can be faster because we know how developed markets have evolved, right? So now we look to the West and we say, okay, when they were at 17, how long did it take them to get to 50? Now that's taken, if I'm not wrong, around 2 decades or so. So it's been a very gradual move.
Right.
But the point is, Indian investors can already see that.
Right.
There will come a point wherein they will have access to this data and they will say, okay, people there are doing that. And in the US, it's not that active investing it's not active driven or something, because they're seeking alpha in different places. They're looking for it in setups like AIFs, private investing.
Right.
So that's where they're seeking their alpha.
Right.
Because the markets have become much more efficient in a public domain. There's not much informational edge and all of that. So which is why we believe that, and personally I believe that the shift can be a little faster. It will be very difficult to put a number of years or anything like that.
Right.
But it will be, I would say, slightly faster than it has happened in the US. But it eventually is bound to happen.
No, precisely.
Yeah.
And I think this also kind of connects well with Navi's strategy on simplicity, from a product perspective, and affordability and digital access as well, right? So how do these ideas show up in actual investor experience?
Yeah, that's a very good question actually, because at times we talk about it, but how does it manifest into investor experience?
Exactly.
So one is the way, there are a couple of ways where it can, right? One is on the product side. On the product side, now this can be very simple. Like we have a suite of very good passive products. These are simple to understand, very transparent. For an investor who doesn't want a headache of picking a fund manager or this, I just want exposure to a benchmark, you can invest in these.
And I just wanted to stress on that point, because especially important, right? I mean, when you have now, let's say, more than a portfolio of 600 funds available, for someone who is just beginning their entire investing experience, why bother, right? I mean, go with the low cost passive product, which will at least get you index returns.
Yeah.
Instead of trying to, figure out yourself, or, so I think that's one of the best way. Of course, the more complicated way is to then get a financial advisor and then get more alpha in your portfolio, etc. But I think you are making a great point that this is like a great way for investor to get started the journey on, right?
Yes, absolutely. And so one is product. You can do very good product.
Right.
On the active side, the product, obviously the metric should be your returns. You should be beating the benchmark consistently. That is very important there. So from a product standpoint, you can make it very transparent. You can make it a very simple, broad-based products, which is what we like to do also on the passive front.
Right.
The second is in your investing journey. For example, if an investor were to try investing on the Navi app, the journeys, we've simplified it to the best of our ability in terms of and being cognizant of all the regulatory steps that are required. We've made sure that the journey is as simplistic as possible. It's as easy as possible for a customer. And third is a thing that customers are very concerned about. If you think about it from a customer lens, there are two things he'll be concerned about. When he's investing, when is he allotted units? When he redeems, how soon does he get his money
back?
Right?
Yeah.
So whatever tats that those tats are regulatory defined, right?
Of course,
those tats are regulatory defined, and we try and ensure to the best of our ability we adhere to those tat as much as possible. And another call out there is we endeavor to provide T+1 redemption. Actually, we endeavor to provide it on a best effort basis.
Most is T+3 otherwise, right?
T+3, T+2 types. But we endeavor to do it T+1, and a large percentage of that we do fulfill over T+1 based on our data over the past few months.
Fabulous.
So we try to do that. So those are some ways in which we try to add some value to the investor's life.
That's awesome. And I want to ask you one last question on the entire Navi strategy, right? But how do you think about working with research-driven advisors, or for that matter, mutual fund distributors? And especially, we have seen that some funds try to grow very fast, by driving the whole distribution channel with a certain incentive model, etc. But what is Navi's approach in terms of working with both the advisor and distributor community?
Yes. So we are very clear on one thing. As we spoke about penetration, it's very low. To drive last mile penetration, you need mutual fund distributors and advisors, right? For instance, if I were today to go to a low tier city and I try to convince even one household that, hey, you start your investing journey, and let's say I'm dressed the way I am now, they will not
work.
It will absolutely not work.
Right.
I'm not from the community. They don't trust me. They'll think he's some corporate guy who's going to run away with our money eventually.
Right.
So that's what
trust is a very important factor.
Trust is very important. But if it's someone local, it's their family friend they've known for decades. If he's an advisor there and he tells them, he obviously understands locally how to speak to them. He understands the language. And in India, one thing we've realized is, as we keep traveling across the breadth of the country, is India is a country of so many micro markets. Every market is very different. The driving factors are very different. Which is why, on your point on advisors, we will continue to work with advisors, because we believe our goal of making financial services accessible, they are a key factor there, because they help us drive penetration. Right. Secondly, on the research driven, as you rightfully pointed out, and it's very interesting to look at strategies even globally and in India that other fund houses have adopted. Some go the marketing and the sales route, wherein they build that muscle, and that has some value because it investor now trusts the brand, and it's a trust business at the end of the day. But and then there are product led fund houses as well. So we want to be much more product led in terms of, because in the long run, what we believe is, if you break the business down to its bare bones, what is exactly happening here? An investor is investing money and he is seeking some returns, right? So as long as your product is good, that should be the core focus of an AMC business. Which is why even we have a very small AUM in our active schemes, but those are very, very heavily research driven. And that's how we'd like to build it. Over the long run, we believe that's a better strategy than to be out there or too much and more than something like a sales or something. It pays much more if you actually work with these distributors for the last mile, because that actually generates a lot of brand value for you, because those people are then aware that, about the brand. So that's how we are looking at the business.
Clearly. So what you're saying is access becomes an important element, but the key DNA will still be a product. And clearly some of the channel partners like advisors, etc., will also understand the the client's risk
Absolutely.
profile there. They will have a far better understanding of what their needs
Absolutely. Yeah.
and requirements are, and be able to match
Yeah.
with the right
Yeah.
products as well.
Correct.
So
And more than
becomes
that,
important.
actually, what the local distributor can understand is the client's behavioral bias.
Yes.
And that differs from what I've seen, it differs from
Yeah.
city to city, not even
Yeah.
state to state.
Yeah.
So he understands that better than anyone
Yeah.
else. So,
No, this
yeah.
is one thing, by the way, I've learned, Aditya, personally myself. I mean, I was on the consulting side for 25 years.
Yeah.
And I always thought finance was a numbers game. But I'm now realizing after 18 months, of working in this space, it's 50% psychology. It's 50%
Absolutely.
numbers,
I
but
agree
it's
with you.
50% is all behavioral
Yes.
piece. And that becomes a very important
Yeah.
element, as you rightly pointing out. So, Aditya, talking about the retail participation, right? Now, the retail participation has grown significantly over the last few years.
Yeah.
But what is still missing for investors, to achieve consistent long-term outcomes?
Yeah.
What would you advise, basically, if you
Yeah.
have to give an advice to a retail investor from a behavioral standpoint, right? I mean, what would that be?
Absolutely. So, as you correctly pointed out, 50% of things in the market seem to be psychological, right? And long term, if investors are seeking long term investing outcomes, they don't behave in a manner that is consistent with achieving those outcomes, right? Because what ends up happening is the ease of access today. For example, I can see my portfolio literally every day.
Every second.
Every second. I just have to log in. There's a facial recognition. That's it. I can see it.
Right.
How much up, how much down. And that type of behavior will always lead you into trouble. Because even data shows, I think there was some study or some data out there that saying retail investors are the ones who end up losing money a lot
The most,
than the other smarter sort of investor diaspora. So for the retail investors, my first recommendation would be stay disciplined. Now, the thing with the behavioral biases is people say this all the time, right? That, and I'm sure you've also interacted with other people who've said this, that stay disciplined, don't touch your asset allocations unless necessary. It's very easy to say that, but behavioral biases are very difficult to tide over. So I would rather suggest adjust for that behavioral bias. And what I mean for that is, let's say you have 100 rupee to invest, you're okay with losing 5 rupee. Let's say 5% of your portfolio, you're okay. If this goes, nothing in my life is going to change substantially. Take that 5 rupee, you do whatever you want with it. Satisfy all your behavioral biases using that. You go, you take a bet, you virtually gamble with it, it's okay. You think of that, put that in a separate account mentally, and just say, this is money, I'm going to keep moving. I'll do whatever I want. I don't care about this part of my money.
But the rest,
just leave it. Just don't look at it every day and all of that. So
that's, by the way, brilliant advice. I mean, so one can always have a risk capital or whatever you want to call it, trading capital, or things where you want to potentially, you have conviction on, you want to take bets, etc. But for the rest, you must stay disciplined in terms of building out the long-term financial outcomes. So that's a brilliant strategy, brilliant advice, by the way. Thanks Aditya for that. One other question I have is, is today's investors have access to lots and lots of products. So as you rightly pointed out, number of AMCs has increased. Outside of AMCs, we are seeing investors, like there is every day, like a new AIF scheme coming to the market, or people are taking bets even on unlisted, equities, or even startup investing is happening. There are, some different commercial real estate products coming out in the market, which are in financialized form, etc. Right? So how should people, cut through this noise, right? Because it's always like something, like MLDs have come. Of course, gold, silver, ETFs are there. So and that's proliferating. I mean, every single day, the more products are coming. So how should investors think through, navigating that maze or noise or whatever you want to call it, right?
A couple of things are, investors should know their goals very clearly, right? You classify your goals into short and long term, at least do that. Because time horizon is a very good indicator of the risk that you can take. Once you know your short term and long term goals, and then and it's very easy to do that, right? You can put numbers to it, whatever it's education, retirement, medical expenses, whatever it is, and then you put numbers to that, and then you will know that how much income you're generating, how much you currently have, how much you need in the future, and that also helps you take off something unnecessary that you want to buy some very expensive car or something which is not needed, and just cut that off, that I don't have the means. So do that first. Do that first. Secondly, be investors need to understand. Investors end up chasing returns, but at the same time they are also chasing higher risk. You
Yes.
forget about
Second
risk.
equation.
Yeah, risk is very difficult to, and if you talk to an investor that you're taking risk, it's very difficult for his brain also to comprehend, because I think even we in the community, we at times keep talking about this. It's look at risk adjusted returns and all of that. It's going to be very difficult for an investor to comprehend what a Sharpe ratio is, what is the standard deviation, and all of that. But think about this. You can think about it in these terms. If you're investing in X asset class, you have, let's say you have a 50% chance of losing your money completely. Or if you lose your money, how much will you lose? It'll be different for debt, it'll be different for equity, different for private equity.
Right.
It'll be very different, the amount of money you lose if something goes wrong.
Right.
So based on that, that will give you an answer of, okay, I have appetite to take this much, but not this much. And thirdly, the biggest suboptimal thing that investors tend to do is they engage in herding behavior. And again, this is a behavioral bias. Just saying it out loud is very difficult for an investor to stay away from it, because everyone is investing in a certain theme. There is always that FOMO of that I'll miss out.
You will miss out.
You will miss out. There's always that peer pressure. Very difficult to get away from it. Even seasoned professionals like us are prone to sometimes get caught up in these.
True.
Especially fund managers, we tend to get caught up in this.
Right.
If you are not away from the noise, and that's very difficult to do, which is why I always said it's always better have some money wherein you do this.
Right.
So that is always satisfied, and then you have an allocation which you don't touch at all.
Right.
Yeah.
Awesome. So we, Aditya, we have a lot of, and especially our audience, right? So we have a lot of mid-career professionals as our client base today. People who are between 35 to, let's say, around 50 years of age, who have done well in the career. Some of them have risen to a CXO level position. Some of them are, mid-level, like heads of marketing or head of a particular product division, etc.
Yeah.
Now, for that particular age group, or maybe we can even tighten it further, right? Maybe, let's say, between 40 to 50 year age group, what should a ideal kind of a portfolio construction, what it should look like? I mean, in your view, maybe any thoughts, suggestions, or advice that you have there?
Yeah. So I've always had this view about portfolio construction is it is very customized. That's the reason that I also said that you need advisors and MFDs today.
Right.
You need distributors and advisors today, because I could be a 40-year-old with no obligations, with no children. I'm just married. It's just me and my wife. I'm earning reasonably well. I have absolutely no
dependents.
No dependence, nothing. So my risk tolerance is very different from someone who has 2 kids, who has to support his parents. It will be very different. Very
and the risk profile, the risk appetite will also be very different.
So all these standardized asset allocations that you go through will not work for everyone. But what always helps is, I'm assuming because you're 40, you're a mid-career sort of professional, your salaries are at the upper end of the curve in terms of, if you look at it from a broader macro standpoint in India, right? You should not only be saving, because people tend to say this, that save 20% of the salary. You should be doing more. Unless you have a lot of obligations, you should be saving more.
Right.
You should be saving 30-35% of your salary.
Oh, wow.
Because now you have if you're 40 years old, you don't have too much of a runway.
Right.
And with the world changing because of AI and all of that, you don't know tomorrow what's going to happen. Right. And your salaries are high. So the absolute quantum that you will be investing will be very high.
Right.
So in 5 years' time, you can have you can actually build a decent sized corpus, which tomorrow, if something happens, there is some bit of uncertainty with the job market and anything.
Yeah. Especially we are going to live in that world.
Absolutely. So you have to be cognizant. So 40-year-old guy, I would say, build that habit. Like that is money that you think of it as EMI. It has to go.
That's a fabulous advice. I mean, and I think we have seen the savings number actually dip, especially post-COVID. People started spending more on experiences, etc.
Yes.
But I think you have a great advice that given the kind of uncertainty forward, and given that the runway for retirement will be relatively low, and then they will have more kind of life goals to fund for as well. Maybe kids, let's say overseas education for all that, I mean, that will, you will have to break the bank for that, right? So, but I think it's a great advice.
Yeah. And one more thing on that is, even let's just put retirement aside also. But if you have enough corpus wherein, let's say you're at a job where you're not happy, maybe, because a lot of people I read a lot these days about burnout, right?
Mm.
About burnout. And it could be the case, you're truly burnt out. If you have enough corpus out there sitting that say, okay, I can stay at home for 6 months, my lifestyle isn't going to change massively. I'll not dip into my savings all that much, but I can do that. I can figure out what could be my next step. Or obviously this is a nirvana sort of status wherein you've accumulated enough wherein you can actually
retire
early and do something of your own.
Right.
But those are real goals. I mean, those can be accomplished if you're disciplined, but it takes time.
Yeah, to get there.
Yeah, and our heads don't comprehend that because it's going to take 10-15 years.
Yeah.
But you think about the next year and it becomes very difficult to see that picture, but it happens.
So coming on to the last section, Aditya, we want, again, you have shared a lot of advice, but this is where we want to even further distill it down.
Yeah.
So over your journey of managing investor capital, right? And you said there's a very large accountability which comes along with it. But what has been the most important lesson about long-term wealth creation?
About long-term wealth creation, I can talk about when I was investing investor money myself. The biggest thing is to have that sort of conviction and to stand true to your conviction. Stand firm on your conviction. Even if you've bought something, it's dropped tomorrow by 10-20%.
Yeah.
You have to realize that you can never get the timing right. Timing is the most difficult thing in the markets to do.
Right. Even for advisors, even for fund managers.
Yes, absolutely. Right. And if you understand that, and if you do understand that nothing much has changed in a business, you need to stand your ground. You should stand your ground, because then the returns are, they give you a very sort of, you could call them non-linear.
Right.
It's very non-linear. When the returns come in, they could be large. And
so only exit when the conviction breaks, but otherwise stick with it. Yeah.
Don't come under pressure for short-term performance.
Perfect. So one other question I want to ask for investors listening today is, what mindset or discipline would you encourage them, other than what you just talked about, to adopt for the next decade? Because, of course, we have seen great 4-5 years from 2020 to 25, and maybe even from 2013 all the way till 2024. Let's say that decade was great decade. Yeah. But for the next decade, again, what kind of mindset they should adopt, or what kind of discipline they need to build?
Yeah. So we spoke about discipline. So that the basic things of just investing every month and all of that. Those I think investors understand also to a large extent with the product like SIP picking up as much. Secondly, one thing I would like investors to also understand is, we talk a lot about our markets. Obviously, there'll always be a domestic bias because we live here.
Right.
Always. So we think that if you look at it from a very, very broad lens, like you are investor X, so you're telling me that you're going to invest whatever 80-90% of your portfolio, which is exposed to only one market, which is exposed to completely on one market, and you're saying this market is so good. So when we talk about diversification, and I think now people are starting to talk about it, is think about things
global
like global markets. The access has become easy now.
Right.
You have very good products. You have gift city products.
Right.
You have platforms that allow you to invest in these stocks directly.
Right. With all the LRS limits, you can you can take advantage of that.
You should take advantage of that. Yep. Obviously, it's not at a point wherein it's very easier for a small ticket size investor to invest. Yet, eventually that will also happen. And then you should take advantage of that. And be open to, there'll be asset classes added on. This is my belief going forward. Like you can give crypto a bad name today, but there's somehow, I believe, that will emerge as an asset class eventually.
We'll have to be open to it.
We'll have to be open to it.
Right.
Right now, obviously, even there are regulations at the government level wherein it's not recognized as something.
Right.
So but with time, I think that will change. Be open to that.
Right.
And then there are, obviously, with incomes growing, your capacity to take risk eventually will start increasing.
Right.
Wherein then products like PMSs, AIFs, SIS, those come into the fold. So be a little open toward these new age products as well.
Yeah. Awesome. So I just want to end with one last question, which is, for those who want to explore, let's say, Navi's investment solutions further, right? Some of our clients, potentially the other audience who may not be also our clients, what is the simplest way for investors to get started, start accessing, Navi's offerings?
Yeah. So for investors who already use some investing platform that they have. There are multiple people use. So people, if you're comfortable using that, you can access our schemes through those platforms. For a new investor, we also have our own app, or you can do it through any of the other platforms. And let's say you want to go through the traditional route, through an advisor, through a distributor. We have both. We've always had direct and regular plans both.
Right.
So we have both. So you can always route that for any investor who's very new and who wants to try out a platform.
For a DIY investor, they can reach
absolutely.
Navi's site and purchase products.
Yeah,
and
on our
things
app,
like
you
that?
can absolutely
On an
purchase. The journey is very good.
Awesome.
But if you want a third-party app or something, there are multiple around. I think a simple Google search will also give you a bunch of names out there that you can use if you're much more comfortable using those.
That's awesome. That's awesome. Aditya, thank you so much for such an honest and grounded conversation. I personally enjoyed it, and I think you brought perspective, which actually comes from managing real capital and through different cycles, and that really came through today. So once again, thank you so much. Maybe just one last piece from my side is, which is how we like to end our podcast as well, is just on the personal front, outside of everything else. Like, what are you looking forward to, let's say, over the next month or two? Maybe anything that you want to share, with your family, with your with your friends, etc. Anything that you are looking forward to, or professionally also.
So on the personal front, actually, March tends to be you could say a busy month for me on the personal front, because I have my anniversary in March. I have my birthday in March, so everything gets loaded out there.
Congratulations!
So, thank you. So then there'll always be plans around that. So looking forward to travel. So I'll be traveling, I think, this weekend with my spouse. So those are things I basically look forward to. But yeah, March is in general a busy month for this.
Best wishes for that.
Yeah, thank you.
Thank you so much, Aditya, once again for coming over here. And thanks to the audience for listening to our podcast.
Yeah, absolutely. And thank you so much, man, for having me. It was a pleasure.
Absolutely. Our pleasure as well.